Welcome to TradeTheMBI.com. This is John. This report is for the 9th of October, starting off a new week after the continuation rally. We're, at near the highs. Friday ended up a little bit softer. We expect that to come back. I mean, look at this dip, though, of the DOC. This is shorts all the way underneath the negative 7.5. I mean, it's ridiculously low level. Wasn't likely to sustain itself. So we're likely to see a little bit of strain here, particularly when you get this cross both at the same time. Steel moving below. Cyan is always a little bit weak, which is exactly what resulted in on Friday's action. And orange moving above 13.5. The fact that you have cyan so far under red, though, powerful. If green had dipped below the red here, midterm buyers, at this particular point, you've got both short-term and mid-term buyers kind of fading the situation. It's just been the long-term buyers. And we knew that new fund money was going to come in around the 5th, as it always does. And sure enough, that elevated price just a little bit. That shakeout is getting very extreme. Now, the NASDAQ not anywhere near as overbought. Relatively speaking, you can see the clear differences. Shakeout well below the 15 warning line. We're not seeing this escalated DOC where red is well above zero, and you have this huge reduction in short interest. So a little bit of a divergence between the broader market and the more specific tech-heavy NASDAQ. So if you do see a rally in tech, that really could propel things a whole nother leg higher. Just pointing it out. The euro maintaining over 117 is still well above the 115.5 range that I think is the top end of the preferred spacing, and that's also going to bolster the S&P the longer it stays there, because their earnings that come in euros will benefit from it. TLT, we expect this to head back down to the 120. We talked about that up here at the peak levels, particularly when the short signals came in and we started to see a slow degradation. Even on the reset, barely came down, and just nothing on the shakeout from that restoration. Plus the dips below the red line had to be revisited, and that happened in the form of a gap down and has continued to trail, because the reality is it looks as though the Fed is going to have to squeeze a little bit harder. They were uncertain about things, but clearly, even with the hurricane, the impact has been negligible. I mean, yes, the unemployment numbers weren't that great, but now you're going to have this huge influx of money, rebuilding, new car purchases, the list goes on. And the fact that that's not going to take months before it starts happening is going to fuel things. The dip in oil, again, this is a supply issue, but what we've been looking at is overall demand. And that's been fairly decent. So while we could see the correction coming in oil from this overdone situation, what we're looking at from a broader perspective in oil is that demand worldwide is going to start rising, and that bodes well for worldwide growth, which, again, U.S. makes up a good chunk of it, which indicates that we're going to see continued improvement. Now, will it be over the 3% number? I think that's going to be really critical, because you start to get over that and it gets harder for a lot of people to not justify the tax cuts that are being proposed, and that would boost the market even further. And gold, even though it's been in this doldrums, it's getting oversold here. Still, it's a huge run below the negative 60 line right here on the extremes, and that means that it's continuing. Any pop here is still going to suffer the same weakness as it bases, but once rates are forced higher, then we'll see a whole different scenario. You're just not seeing any version of global inflation, at least the way most people have equated it, and that's because of the continued influx of fiat currencies just really diluting value. But that's going to start to have a baseline impact for gold in the same way that the market is already starting to price in inflation now, which a lot of people are just missing the boat on completely, because we haven't seen it in a decade, so they don't remember perhaps. But part of this market rise is simply that evaluation that inflation is going to grow beyond this 2% range at some point here, and when that happens, you need to be ahead of the curve, not behind it. Because if you're behind it, then forget it, you've already lost. And a lot of people are behind it that haven't participated in this move. We can see from the 5K standpoint, Friday Started off a little weak, started to come back to it, couldn't even get past, I think this is the 76% range there, yeah, right there. And started to get weak off that point, and then the midterm buyers broke down, and we didn't get a reset until right about here. We got our first buy signals right at the 23% line at 43, and just a slow work its way back up. Then we opened up slightly down, but immediately shot back up, and that was just to clear out stops, which is what the market makers love to do off hours, and particularly when they have a low volume situation. Works for them every time. And you can see the massive move right back to the same levels that we were at closing out on Thursday. So not a whole lot of change from that standpoint. In fact, all in all, fairly decent. It's right in line with our expectation that things would be moved to slightly rising. This is a little bit of a preview of that nightmare of the mid-90s where it was just a constant slow ebb, and pretty much you could just leave your money and not do anything. But if we start to see some more of the war drums beating in, I think the volatility could start to pick up a little bit. The reality is, once we start seeing the Fed actually reduce its balance sheet, then I think things can get exciting, because at this particular point, this has been a manipulated market, and we can see it even from our daily results. We're looking at the MBI opuses in that. In fact, I think I've got one handy here. Let's see if I can pull one up. It should be one right here. There we go. So we had this last completion of a Starhawk that took place at 26, and it went up. This is the single version. Let's put up this one here. It's a double. Starhawk, Ironhawk, and then we had another Starhawk right here that took place at 26. Sold out at 39. Performance report, though. This is what I was pointing out. So once we started to see, here was your 2008, 2009 range right in here, all the way up to 2012. And that's when things started getting a lot more active from the Fed as far as manipulation went. And you can see we went really jagged, because for the longest time, throughout 10, throughout 9, we still had excellent angle on the curves. But then we started getting this wonkiness where the Fed was just throwing tons of money at everything. And the idea behind this program, though, is more mean reversion, where you're expecting ups, downs, up, down, up, down. And instead we started just getting long trends, so it took longer to finally build up. Though from a performance standpoint this year, this one, a bit better than it did the previous year. If we go to the one right here, double, even better, just because it's had 37 trades so far for the year now, and only doing the solely 10 contracts. Well, actually, this one has the 2. It just does it a little bit differently in the way it adds and where it does it from. So, well, I guess we should look at what the overall total was. I don't even remember what the percentages were in the 75. Yeah, 75% right on the money. Win weight. With a 2.21 profit factor. So, all in all, pretty close to getting another buy entry or so before the end of the year. We probably will be at all-time equity highs again. Each year has produced a new version. Don't want to go too long. As always, though, trade well. We will be on the Skype chat. Trade well.